You've probably heard the term premium finance, and for most agents and clients, it sounds complicated. But what if I could explain it to you in just 5 minutes? By the end of this video, you'll understand what it is, why the ultra wealthy use it, and how it could be the single most powerful strategy in advanced life insurance. So premium finance is using a bank's money to pay life insurance premiums instead of your own. The policy itself, along with outside collateral, secures the loan. The client keeps their capital invested in their businesses, in their real estate portfolios, or in their investment portfolios, while still getting the protection and leverage of life insurance. It's like financing an office building or a piece of real estate. You don't pay cash for the whole building, you finance it because your money can earn more elsewhere. That's called arbitrage. So why the wealthy use it is, number one, leverage. The use of the bank's money at, let's say, 6%, while their money earns 12%. That's arbitrage. The second reason why they use it is tax efficiency. The policy grows tax deferred and pays out tax free. The third is liquidity. It helps keep their cash available for future deals and future investments when they're able to leverage the bank's money. And the fourth is estate and succession planning. Provides liquidity for estate taxes and smooths business ownership transfer. And what it looks like, as an example, let's say there's a $10 million policy with an annual premium of $1 million a year for 10 years. Instead of the client writing $10 million in checks, the bank lends the client the $1 million each year for the premium amount. The client posts collateral, the cash value of the policy, plus securities, real estate, or other cash or cash equivalents. The client also pays the annual loan interest. The policy cash value plus the death benefit helps secure the loan for the bank. And over time, the policy growth plus the planning strategies are used to repay the bank loan back. Without finance, the client's paying $10 million out of pocket for premiums after tax. With finance, the client keeps $10 million working in the business while the bank funds the premiums. So who's it for? It's for business owners, entrepreneurs, investors with at least a $10 million net worth, even though there's some carriers out there that are at a $5 million net worth or $2.5 million net worth, so long as they all have strong collateral and liquidity. And there's a need for succession or estate planning. This is not an opportunity for free insurance. They also need to be seeking long-term legacy and tax mitigation goals. This is not for clients living paycheck to paycheck, people that don't have sufficient liquidity, people that do not have the collateral, or people just shopping for cheap or free insurance. And here's where the risks and the realities and the considerations come into play. Number one, interest rate risk. Interest rates can rise, interest rates can fall. Collateral, it must be posted and maintained. It requires proper structuring and monitoring of this type of structure. Done wrong, it can be a complete disaster for the client, for the carrier, for you, the agent, for the lender. But done right, it's the strategy of the ultra wealthy. And that's premium finance in less than 5 minutes. Bank money funds large life insurance policy. Client's money stays invested elsewhere. The end result equals protection, leverage, succession, and legacy. If you want to see how this works with real numbers, I break it all down inside the JMac method, the Elite Case Closer Academy. Click the link below and start mastering the same strategies the top 1% of producers use with their clients.